Hey friends, I hope you all are doing quite well in your respective lives. Today, I, Kunal Nagpal, am feeling deeply humbled to welcome you back to this great online portal, Nagpal Econotek Academia, which is actually meant for the economics enthusiasts. My dear friends, in today's session, we are actually going to explore the core intricacies, the real factors which had ultimately resulted to the Silicon Valley Bank crisis. It's actually a major downfall in the entire banking sector. As all of us know, that the US banking sector, led by the US Fed, has been the real strong pillar. However, after this crisis, the entire banking sector of the US economy has actually got shaken. Now, as I've said, that in this particular session, we are actually going to analyze the core factors which have been responsible for this major massacre. So, my dear friends, let's begin today's session with the main understanding and with the main objective to actually learn the basic reason for the SVB collapse. And will the US bank failures bailouts affect India? It's really a major area of study. And my dear friends, up till now, we have seen that is the time period which has actually passed since the SVB collapse. We have seen that the Indian banking sector has been able to insulate itself very well from this particular crisis. So this really speaks a lot about our overall efficiency, which is really excellent. So my dear friends, we have all heard of or read about the Silicon Valley Bank's collapse. Then actually it was followed by the follow of the great event, that is the fall of Signature Bank. First Republic too almost failed, but other large financial institutions actually pitched to shore up the deposits. So why did this actually happen? How did the US authorities react at that particular point of time? Actually, it should be the response and not the reaction, because that's actually reflecting the positive intent of a person or an institution who is being faced with a particular situation, the crisis-like situation, but often in the crisis in today's times, when actually from all around we are seeing various critical situations taking place, a lot of uncertainties prevailing in the entire scenario. It is actually quite difficult to respond with stability. Only a well-dynamic personality would be able to respond with stability in the times of crisis, and often many authorities, many organizations do react. Further, let's analyze, is it okay to use the taxpayer funds to basically save the banks, whether private or otherwise? Now, my dear friends, let's try to understand that what actually led to the Silicon Valley Bank collapse. First, a little bit of history, my dear friends. When the pandemic hit us, the financial authorities, especially in the West, began infusing the easy funds into the system. The Federal Reserve actually infused almost $4.8 trillion into the system between February 2020 and April 2022 at almost zero interest cost. And when the easy money actually became available, The banks such as the Silicon Valley Bank did not have too many opportunities to actually invest. So they pumped large funds into the government securities or bonds. Now, when inflation began rearing its head in early 2022, the Federal Reserve basically began raising the rates relentlessly. Between March 2022 and February 2023, the US Fed had raised the target range from 0.25 to 0.5% to the range of 4.5 to 4.75%. Isn't it really alarming? So, more than 4 percentage points in about a year. This is really a great, astonishing figure. So, we have been able to notice such a huge fluctuation starting from 0.25 and ending till 4.5 in a span of 1 year. And my dear friends, this actually spurred the bond rates up. And whenever the bond rates go up, the price of the bond declines. So there is an indirect relationship between the bond rates and the bond price. Furthermore, this actually pushed down the value of SVB's holdings. In fact, as early as in the September 2022 quarter, the Silicon Valley Bank's unrealized losses from its bond investments were $16 billion, compared with its equity base of $11 billion. After it said on 12th March that it actually needed to raise further funds, the depositors became nervous, taking out $42 billion in one single day. Isn't it really the surprising figure? I repeat this once again, as this is an extremely important and significant essence of the entire matter we are discussing today. My dear friends, as I had told, that in the span of 1 year, that is from March 2022 to February 2023, the US Fed had raised the target range from 0.25 to 0.5% to the range of 4.5 to 4.75%. So more than 4 percentage points in about a year altogether. And this actually spurred the bond rates up. And whenever the bond rates go up, the prices of the bond declines. And this actually pushed down the value of SVB's holdings. In fact, as early as in the September 2022 quarter, the Silicon Valley Bank's unrealized losses from its bond investments were $16 billion, compared with its equity base of $11 billion. And after it said on 12th March that it needed to raise further funds, the depositors became nervous, taking out $42 billion in one single day. Furthermore, Moody's downgraded its rating for the bank because of the fall in its bond portfolio altogether. The stock crashed 60%, sending ripples in the entire market. And in the case of Silicon Valley Bank, its primary client base comprises the startups. As the startups entered the winter of funding, which we talked about in an earlier episode of Business Matters, that particular sector has also tended to fall back upon their bank deposits to basically fund their daily operations. And my dear friends, now let's try to explore that what did the US government actually do to save these banks or their depositors. My dear friends, you may have noticed that historically, the governments have seldom let the banks of significance fail. Why so? Because there is always a contagion effect The banks are actually interconnected in the financial system. There is also a perception problem. Even if a bank is actually technically sound, a mere unverified rumor can basically cause the panic among the depositors. No bank in the world, I repeat, no bank in the world can actually give back all the money it has basically taken from the depositors all at once. Why? Because it actually makes money by lending out those funds to the borrowers. And obviously, it cannot call in those loans at short notice, as it is quite impractical. So, in India, the three large banks are tagged as systemically important or too big to actually fail. And these three banks are SBI, ICICI Bank, and HDFC Bank. Now, in case of the Silicon Valley Bank and Signature Bank, the US government closed those banks, but actually assured the depositors that they could take their money out. So, my dear friends, in this particular session, we have been able to analyze the core reasons of the Silicon Valley Bank crisis, that is, the SVB collapse, followed with the fall of the Signature Bank. And we have been very successfully able to realize the core parameters with an in-depth analytical discussion. And we have realized that it actually began with the pandemic in February 2020. And we also studied that the Federal Reserve actually infused nearly $4.8 trillion into the entire system between the time period of February 2020 and April 2022 at almost zero interest cost. And obviously, when the easy money became available, the banks such as SVB did not have too many opportunities to basically invest, so they pumped large funds into the government securities or bonds. And obviously, when inflation began rearing its head in early 2022, because of the great help of $4.8 trillion provided by the Federal Reserve, further which led to the helplessness of the SVB as it did not have any opportunities to actually invest, so that the money or the large funds may get pumped into the government securities or bonds. That particular reason gave birth to the overall rise in the interest rates from the target range of 0.25 to 0.5% to the range of 4.5 to 4.75% within the span of 1 year, that is between March 2022 and February 2023, when the inflation began. That is when in last year, that is in February 2022, the Russia-Ukraine war began. The Russia-Ukraine war began, which actually led to the adverse supply chain disruptions worldwide. So this actually gave birth to inflation. And in order to curb inflation, the Fed Reserve began raising the rates relentlessly in the band of 0.25 to 0.5% to the range of 4.5 to 4.75%. That is more than 4 percentage points in about a year. And obviously, this led to a sudden rise or an upsurge in the bond rates, which is actually indirectly proportional to the bond price. As a result, the bond prices declined, that thereby causing the pushing down of the value of SVB's holdings. Further, in 2022 quarter, The SVB's unrealized losses from its bond investments were basically $16 billion compared with its equity base of $11 billion. So it actually led to a very haphazard step by the depositors, that is nearly $42 billion, that is on 12th March. $42 billion was withdrawn by the nervous depositors in just a single day. So, in the case of the Silicon Valley Bank, its primary client base comprises the startups. As the startups enter the winter of funding, which we had talked in one of our episodes earlier, that particular sector has also tended to fall back upon their bank deposits to fund their daily operations. And further, we had also discussed that what did the US government actually do to save these banks or their depositors. So it has been a great insightful session, and it actually gives me a wonderful feeling in a tremendous amount to help you understand the core in-depth analysis of the Silicon Valley Bank crisis. And obviously, it's really a great matter of strategic concern in order to develop a proper understanding of the banking sector in the Indian economy, as it's the global economy and every action is actually interrelated. Every action by any particular company in terms of international trade or any modification or re-engineering in any policy governing the nation would obviously affect the other related nations with whom that particular country is engaged in international trade. So, my dear friends, I would like to conclude my session here itself and hope to see you very soon next. Thank you so much. Namaskar. Jai Hind.